Hi, my name is Brianna Brockhaus, and I'm here to tell you why I propose a sell recommendation on Under Armour stock. First, I will list my qualitative reasons, followed by my valuations, and then conclude with the stock to buy in order to maintain a balanced portfolio. Under Armour is facing negative investor sentiment as it faces its investigation by the SEC and Justice Department. The investigation has been ongoing since 2017. On November 4th, the Wall Street Journal reported the investigation and the stock price dropped about 18%. And that same day, the company had released that it beat its third quarter earnings. The Wall Street Journal stated that the company is being investigated for shifting sales from quarter to quarter to make its financials appear better. The exact and full allegations have not yet been released to the public, so unanswered questions remain about whether it's true or not, if it's continuing to take place, or even the extent of the allegations. Without the answers to these questions, the company's future performance will not be of great importance if its investors cannot reliably trust the accounting practices. Whether it's true or not, the market is reacting negatively, and as more investors sell their stock of Under Armour, the price will continue to drop in order to bring it closer to equilibrium with demand. Additionally, a study was conducted on U.S. male consumers with annual income ranging from $60,000 to $150,000. When asked to choose the most innovative athletic apparel brand, 44% of participants chose Nike, which is an increase from an initial 38% from a previous survey. Only 12% of these participants chose Under Armour, which is a decrease from an initial 17% in the same original survey. On the other hand, a survey was conducted on U.S. male consumers who make under $60,000 in income annually, and 25% of them chose Under Armour, which is still a decrease from the original 28% when the study was conducted on them the previous year. There was not data in the article disclosing how many people in this demographic chose Nike, but I did a Google shopping search to compare prices between Nike and Under Armour. And after searching Under Armour shoes for men 2019, I took the average of the first 8 pairs of shoes, and the average price came out to $80.49. Then when I conducted the same search on Nike shoes for men 2019, the average for the first 8 pairs of shoes was $83.86. The lowest price for both brands was $39.99. While it is widely known that Nike carries a higher percentage of higher priced products, they also offer products with comparable prices with Under Armour. So it doesn't appear as though Under Armour is providing prices significantly lower than Nike for the most basic models to create a justifiable amount of value for this lower income demographic, because the difference in the average price of shoes was only about $3. It is important to evaluate the economic environment that Under Armour faces if it is to remain a leader in the athletic apparel space. Under Armour is at a disadvantage competing with Nike as the company operates its economy of scale with a market cap of about $110 billion, while Under Armour's market cap is only about $10 billion. Nike has also begun a series of plans to gain more market share by increasing its speed and innovation of operations, as well as its connection directly to consumers, which seems to be working, as can be seen from the survey results. Adidas has a market cap of about $60 billion, and according to Jeff Van Sinderen, a B. Riley FBR investment banker, Adidas has been able to significantly penetrate the U.S. market in recent years so much that its demand exceeds supply. It is important to note that Under Armour has had a net loss the last 2 years, going from $198 million in net income in 2016 to a net loss of almost $48 million in 2017 and $46 million in 2018. The company claims these are due to restructuring costs in response to slowing demand. While these restructuring charges will not last forever, it is clear that the company faced enough decrease in demand to justify spending tens of millions of dollars on the issue. If the impact was severe enough to justify that much spending to restructure the company so it can officially operate with slowing demand, there is clearly a big issue at stake for the company's future. My valuation of Under Armour stock was based on a discounted cash flow analysis as well as a relative valuation using comparable companies. To conduct my DCF approach, I had to make a variety of assumptions, regarding the company's future performance. I utilized Bloomberg information when calculating the cost of debt and equity to get the WACC. Specifically, I used the adjusted beta of 1.464 from Bloomberg. Yahoo Finance states a 3-year monthly beta of 0.6, but I did not think that it used enough data in its calculation. And because I think that Under Armour warrants a beta of at least above 1, I went with the Bloomberg weekly calculation. Additionally, I used the 5-year forecasted average for revenue growth, which came out to 5.25%, which I deemed to be a fair assessment for the company, seeing as how revenue growth went from about 22% in 2016 and dropped to about 3 and 4% in the 2 subsequent years. I also used the 5-year forecasted average for EBITDA as a percentage of sales, which came out to 10.34%. And for EBIT as a percent of sales, it came out to 6.96%. I also chose a terminal growth rate of 3% because I felt as though that was a sustainable rate since revenue growth has only been about 3 and 4% in recent years. And because demand is slowing, I went with the lower of the 2 numbers. Under these assumptions, which I deemed to be fair considering Under Armour's recent performance, I came up with a value per share of $7.68. To conduct my relative valuation, I utilized FactSet for Under Armour's comps, and it came out with Adidas, Columbia Sportswear, Nike, Skechers, and Hanes brands. I have already discussed Nike and Adidas as competitors, and I think these are all good comps for the company as they all operate within the same line of business selling sportswear, footwear, and casual wear. I used the average EV to EBITDA multiple of 14.94. I then multiplied this by the most recent historical EBITDA value and came up with a stock price of $11.48. Because I only utilized 5 comps in my relative valuation, I thought it was best to weight the comps approach at 30% while weighting the DCF approach at 70%. My final target stock price came out to $8.27. When you compare this valuation with the current market price of about $19 per share, it is clear that Under Armour is currently overvalued. Therefore, I propose a sell recommendation when it comes to Under Armour stock. In order to maintain a balanced portfolio after you sell your Under Armour stock, I recommend buying shares of Nike. As seen from the surveys conducted on U.S. male consumers, it is clear that Nike continues to gain market share. With its massive market cap and economy of scale, it is the clear frontrunner in the athletic apparel industry. I have also shown that the lower income demographic does not gain much value from shopping at Under Armour versus Nike. And when you pair this with its recent initiatives to reach consumers and boost productivity, it is a solid buy as the company is set to remain a leader in the industry for years to come. Thank you.